You all. So, good afternoon to you all. So, in our last class, we have started our 10th unit, in which we have seen about, you see, we have seen about multiple performance measures. And this unit is about performance evaluation, where we have already seen about the introduction of it. We have seen about multiple performance measures. Okay. So, in our today's class, we'll continue with 10.3. That is going up with performance evaluation criteria. So basically, this performance evaluation criteria, it refers to the standards and the methods that will help us to judge how well a division or the manager of its division is performing their work. Okay, so for a fair and accurate evaluation, here we are considering three elements. Okay, and these three elements has to be computed correctly. So what are those three elements? The first is your cost, second is your revenue, and the third is the capital that is being employed. Okay, so these three elements may be controllable or traceable. And ultimately, their correct identification is very important. If you're making any mistake in computing it, that will lead to wrong evaluation of divisional performance. Okay, no doubt there are some difficulties in order to evaluate the performance evaluation. That is, sometimes it becomes difficult to identify which costs are controllable by a divisional manager, or how to decide which revenues are influenced by a particular division, and how you are going to allocate capital employed among divisions in a very fair manner. Okay, so therefore, before designing an evaluation system, you have to have an in depth study of it. An in depth study is required to design an evaluation system. So, with in lieu to this, what are the responsibilities of top management? The top management or the central management, they must ensure the following like accountability. Okay, so basically accountability means lower level managers, they are accountable to higher level management. Goal alignment, all employees and managers, they should work towards achieving their corporate objectives. There should be a fair allocation of objectives. So, corporate goals should be equitably and rationally divided among all the divisions of an organization. And here, the evaluation should be done on neutral basis. That means the divisional performance should be evaluated fairly by comparing the assigned responsibilities as well as what is the actual performance that is being achieved. Okay, so when we are speaking about divisional performance, this divisional performance we are going to calculate with the help of controllable factors. So, to fairly judge, only the factors which are under the control of management should be considered. Okay, that means divisional rate of return is there. How you are going to calculate division rate of return? It's nothing but controllable revenue minus controllable cost by controllable capital whole multiplied by 100. Okay, so this particular formula is helping us to highlight what are the efforts to reduce unnecessary cost and how you are going to increase your sales or your internal factors, as well as what is the efficiency that is being used in your capital. So it directly reflects the manager's performance since we are considering only the controllable elements. Okay. Now, what is the need for these traceable factors? In reality, many times it happens divisions, they may use services of other divisions. Okay. And the revenues may be influenced by some common branding or some common marketing methods. And whatever the capital that is generated it is being employed and it is being shared with the members of the organization. So therefore, performance evaluation should consider the traceable cost, revenues, as well as the capital. Okay. Now, coming towards your non financial or operational performance parameters. Apart from this, that is, apart from your financial measures, divisional performance should also be evaluated using physical and operational indicators such as your material wastage percentage, okay, your labor productivity, your unit material cost, man days lost, capacity utilization, percentage of scrap and defectives, machine breakdown frequency, overtime and idle time costs, and also unit cost. This is specific and common. Okay. So the difference between this expected and actual performance are only identified. And also, whatever the reasons for deviations are there, they are being analyzed. So here the responsibility is fixed on concerned departments or on managers. Now, when performance reports includes your columns for all divisions, that means you are trying to compare performance reporting. It allows your inter-division competition. Okay. And also it helps us to identify the best performing divisions and also create a healthy competition. Okay. So when we are trying to compare performance reporting, this will motivate the division to improve their performance, which help the organization to achieve its overall objectives. Now, next coming towards is your balanced scorecard. Okay. Balance, what do you mean by a balanced scorecard? Balanced scorecard will try to measure performance and also it helps the management system to convert the strategy into action, which uses both your financial and non-financial measures. And basically, balanced scorecard will focus on long-term value creation. And the concept of this balanced scorecard is introduced by or developed by Kaplan and Norton, where they try to address the limitation of traditional financial measures. Why this balanced scorecard is needed? What is the necessity for it? Basically, balanced scorecard is needed to reflect the past performance. That means here financial measures will reflect your past performance. Sometimes they became so inadequate for information age organizations also. And nowadays, many of the business, that is modern business, they depend on customers, technology, they depend on innovation or process or employees. So, with this, we can say it is trying to integrate your tangible as well as intangible assets. Okay. Now, what are the features of balanced scorecard? The balanced scorecard will try to translate your vision and strategy into objective. And also, it tries to link your short term actions into long term goals. Okay. Apart from this, it will also help us in your strategic planning and control. And this is one of the management tool, okay, where we try to evaluate the performance. It is not a measurement tool, it is a management tool. Okay, so these are the key features of your balanced score card. Now, what are the four legs of balanced scorecard? The four legs of balanced scorecard from four aspects of a business are learning and growth, business process, customer perspective, and financial data. Learning and growth. Learning and growth means employee training, going up with skill development programs, going up with innovation capability, okay, knowledge management. So here our main focus is to go for future readiness and competitive and create competitive advantage. Second leg is your business process. These are evaluated by investing how well products are manufactured. Operational management is analyzed to track any gaps, delays, bottlenecks, shortages, or waste. So basically, internal business process perspective focuses on efficiency of production, process improvement, and also reduction in waste, delays, and bottlenecks. So here our main focus is on operational excellence. Third leg is your customer perspective. Customer perspective are collected to gauge customer satisfaction with quality, price, and availability of products or services. That means here customer satisfaction, quality, price, and delivery, and customer loyalty and feedback are taken into consideration. So, our main focus is on market success. Next leg is your financial perspective. That is going up with your financial data, such as your sales, your expenditures, and your income, which helps us to understand your financial performance. So, here we are trying to focus on financial health of the organization with respect to sales growth, with respect to profitability index, with respect to your cost control and return on investment. So, all these four legs or four perspective together, this will helps us to represent the vision and strategy of the organization. Next, coming towards your contribution margin approach. Okay. Contribution margin approach is nothing but in this first we are going to see about profit margin concept. So what is the formula that is given for profit margin concept? Here there is a table that is being mentioned over here with which we can analyze profit margin equal to profit sales by profit sales and sales profit. Okay, so here there is a table that is given. Sales figure. In this, we are just deducting variable cost, then deducting controllable divisional overheads. This will give you the value of controllable profit. And then we are deducting variable expenses. This will give you contribution margin. Again, we are deducting allocation for fixed expenses. This value will give net profit before tax. From this, we are deducting tax. Then you will be getting net profit after tax. Okay. So here you have divisional profitability that can be measured using net profit. This net profit can be before or after tax. And also we are measuring operating profit. And what is one of the limitation over here? Net profit may be distorted due to sale of assets or there might be some abnormal gains or losses. And operating profit is something that is the profit earned from your core business activities. So higher operating profit indicates you have better operational performance. Okay. Next concept you have contribution margin statement. Right? So what do you mean by this contribution margin statement? Here we are trying to emphasize cost controllability and its allocation, like how we have seen the table. So what is the importance of this approach? In this approach, we are trying to separate the controllable as well as the non-controllable cost. And also it gives you the fair evaluation. Apart from this, it will help the manager to take decisions properly and also to highlight real contribution of each decision. So in simple words, performance evaluation must be fair and objective. It should be a controllable factor that can be judged by a manager, and financial and non-financial measures are equally important in this. And also balanced scorecard ensures long-term success, and contribution margin gives a realistic picture of your division profitability. Next, coming towards return on investment. So, return on investment, this is a measure, that is performance evaluation measure, where we are trying to assess how efficiently a division uses its investment to generate profits. Okay, so in simple words, return on investment is nothing but here it will try to show you how much profit is earned for every rupee that is being invested in a division. Okay, so this is a most commonly used method where you have divisions, n number of divisions in an organization. Okay, so how you are going to calculate it? Here you are going to calculate return on investment by dividing divisional income, that is profit before tax, by divisional investment, that is assets employed. Okay, coming towards different bases of investment. Return on investment can be calculated using your total operating assets, total operating assets minus current liabilities, net operating assets. So here you have a formula for your return on assets based on total assets, right? That is return by sales into sales by total assets. And there is one more formula, return on assets with respect to your net assets. That is return by sales into sales by total assets. Then you are multiplying this particular value with total assets by net assets. Okay, so this is one of the most common form of performance evaluation in divisionalization company. Next, what are the components on return on investment? Okay, in this return on investment, we have one component that is return on sales. So, how do you calculate the return on sales? Here it is given as return on sales equal to, first of all, this return on sales is also called operating profit percentage, where return on sales is equal to divisional income, okay, by divisional income multiplied by divisional revenue. And this particular thing, it measures cost of efficiency, wherein it helps us to show how much profit is earned from sales. And it indicates your manager's ability to control your costs. Next is assets turnover ratio. In this assets turnover ratio, here it is being calculated as sales investment by asset turnover. Okay, so here this asset turnover will measure asset utilization, and also it shows how effectively assets are used to generate sales. And what is the importance of breaking this return on investment into components? Why are we breaking it? Because it gives us a deeper insight than a single figure. And also, it helps the management to identify whether profit margin is low or high, or if asset utilization is inefficient or efficient. And also, this particular component is useful for your financial analysis and control. Next is your residual income approach. Residual income is nothing but this is the profit that is left after charging the cost of capital on the investment that is used. Okay. So, in simple words, this residual income, this shows how much profit is earned over and above the minimum required return. And what is the formula for your residual income? Residual income is equal to operating income minus investment base into required rate of return. Okay. Required rate of return is nothing but that is your cost of capital. So in financial accounting, why this residual income is needed? It is needed for interest on debt that is deducted. And also here in this case, cost of equity is ignored. So this particular value will hide the true economic performance. Okay. Next, you have a table of residual income statement where revenue minus variable cost will give you contribution. Contribution minus controllable fixed cost. This gives you the value of controllable profit. Controllable profit minus interest on controllable investment gives controllable residual income. From this, when you are deducting uncontrollable costs collected, that includes your head office charges, and also when you are deducting interest on uncontrollable investment, this will give you net residual income. Okay. So, what are the advantages of this residual income? It considers your both profit and cost of capital. It encourages your optimal investment decisions. Okay. It is consistent with your NPV method. Okay. Next, it focuses on absolute income, not on percentages. Fifth point is residual income objectives that will lead to the achievement of desirable levels of total earnings and EPS at the corporate level. Next, unlike the return on investment, RI approach, that is residual income approach, is not concerned with preserving a relative measure. That means here it encourages the shareholder wealth maximization. Okay. Next, the cost of capital charged on divisional investment ensures that managers are aware of the opportunity cost of capital. That means here we are making managers to be aware of opportunity cost of capital. And what are the disadvantages of it? The first is an accounting measure, that is residual income, has all the defects of such measure. That means based on accounting data, it is difficult to define divisional income. And also, it is difficult to measure your divisional investment. and allocation of controllable and uncontrollable factors becomes complex in nature. And accurate computation of cost of capital is very difficult to identify. Okay, so when I'm just trying to make a differentiation between return on investment and residual income, return on investment gives you a percentage measure, whereas residual incomes gives you absolute value. So here residual income focuses on percentage, whereas residual income focuses on value creation. Next difference is return on investment, it focus on rate, whereas residual income focuses on wealth. And also this is short term oriented, that is return on investment is short term oriented, whereas residual income is long term oriented. Okay, so in simple words, return on investment is how efficiently we are using money, and residual income is how much extra profit is earned after the cost of capital. So return on investment focuses on percentage, whereas residual income focuses on value creation. And residual income is more superior for long term decisions. Okay. Next, we have economic value added. This particular concept is an advanced form of residual income, which helps us to measure the true economic profit of a business or division. In simple words, this economic value added, it will show whether a company is really creating wealth after covering the full cost of capital. Okay, that means it is showing whether a company is really creating wealth after covering the full cost of capital. And this concept was developed by Steen Seward and Company, and it is the registered trademark. So, however, the concept of residual income existed before this, and it is in the public domain. Okay, so how you are going to calculate economic value added? Economic value added is nothing. Economic value added is nothing but net operating profit after tax minus economic book value of assets in place X multiplied with weighted average cost of capital. Okay. So here economic value added is something where operating profit after tax is getting deducted with cost of capital that is employed to generate the profit. And this is also called economic profit. Okay. And here there is NOPAT is that is net operating profit after tax. That means here profit after depreciation and tax before interest. This represents your profit available to both your lenders as well as your shareholders. Now, how you are going to calculate your weighted, that is multiplied by weighted average cost of capital is given, right? This is nothing but average cost of debt and equity. Ultimately, this will reflect your minimum return that is expected by your investors. So here, what is the interpretation that we are coming across? Positive economic value added is something that the company is creating a value. And if the economic value added is zero, at that time it represents that the company earns exactly its cost of capital. And if you are getting EVA as negative, economic value added as negative, that means the company is destroying its shareholder value. So here positive EVA gives that the company is creating a value. If it is giving zero EVA, that means the company earns exactly whatever the cost of capital that is employed. And negative EVA is something the company is trying to destroy its shareholder value. Okay, why are we evaluating this economic value added? Because it helps us to measure your true wealth creation. And also, this will align with your management decision along with your shareholders' interest. It encourages your efficient use of capital, and also it will help you to improve your long term performance evaluation. So, for that purpose, we are making use of your economic value added. Now, next is evaluating the economic performance of an entity. Okay, so how you are going to evaluate it? The first we are going to see, how, what is the, what do you say, the difference between your managerial performance and economic performance. So, managerial performance, it evaluates your managers, whereas economic performance, it evaluates your business unit. Okay, and also in your managerial performance, we are preparing your monthly and quarterly reports. Whereas in economic performance, it is prepared at long intervals. And managerial performance is based on historical data. Whereas economic performance is based on, what do you say, future perspectives or future expectations. And one important thing is managerial performance, it focuses on control. Whereas economic performance, we are focusing on strategy rather than control. So, economic performance reports are diagnostic tools where it helps us to assess whether current strategies are effective or not. Okay, and also it will help us to decide whether to go for expansion, whether to go for what do you say, redirection, or sell a business unit, or sometimes it shrinks your business. Okay, and what is the need for this economic evaluation? Sometimes it may happen the individual decisions become, or it may appear more profitable. And this combined effect that will lead to your poor future performance. So, in such cases, the economic analysis helps us to identify such hidden issues. There is one more concept given over here, breakup value of a company. See here, you can see breakup value. What is this breakup value? Breakup value is nothing but this is the estimated amount of shareholders that they receive if business units are sold separately. And it is useful for your takeover bids. It is also useful for your strategic decisions and internal performance evaluation. And there is a gap between current profitability and breakup value that will indicate the need for strategic change. And also, they focus on future profitability. This is one of the most important feature of economic evaluation, that is emphasizing on future earnings, not past profits. Okay, so the value of a business unit is nothing but present value of future cash flows discounted using required rate of return, and also it includes your terminal value. So your thorough estimation can be rough, but they provide a strategic perspective. Next is performance reports. Performance report is a formal statement that will show you results of activities, and also it will help for comparison of actual results with your budget results and your standard. So here the variance is expected between expected and actual reports or actual results. So, what is the purpose of this performance reports? It will help you to evaluate your efficiency, your effectiveness, and also it will help you to identify favorable and unfavorable variances, and also to enable your corrective actions, and also supports your managerial decision. Okay, like how you will be preparing your annual appraisal report, or a kind of what do you say, department annual report, or profit performance report. Okay, what are the uses of performance reports? How it helps in an organization? It will help your board of directors, it will help your owners and shareholders, and those who are charged with governance. For these people, performance reports matters. I mean, they are the users of performance reports. Board of directors, your managers, your owners and shareholders, government authorities, and those who are charged with governance. Okay. What are the key features of your performance report? What are the key features of your performance report? How it should be? You should have an appropriate level of detailed report. That means you should avoid too much information, and also you should avoid too little information, and you should focus on what the users need. And the report should be clear layout, and it should be presentable. That means proper headings has to be mentioned. The report should consist of a kind of a logical structure, where you should be making use of charts, graphs, or highlighting some figures, key figures you call it as. Okay. And also the report should consist of explanation and narratives. That means the variances must be clearly explained. What are the causes of unfavorable results? That should be identified clearly. And also, it prevents unnecessary follow up questions. Okay, you should make use of your benchmark, that is, comparing with your past performance, comparing with your budgetary performance and industry competitors. So, while you evaluate performance report, you should ensure that it should measure your organizational mission. It should reflect the objectives and sub-objectives. Okay, are they clear? Are they relevant and understandable? And also, it should highlight important variances and trends. Okay, so um you should also take into consideration some recommendation, that is suggest improvements. Okay, you should focus on usefulness rather than the quantity of your data. So in simple words, this economic value added, this will show you the real profit after cost of capital. Economic performance looks at future value rather than past performance. Sorry, past profit. Then your performance report will help managers to take corrective action. So here, clear, focused report should improve your decision making. Coming towards a summary of this unit. So in this unit, we have seen it has clearly explained why and how the performance is measured in large organizations, especially where divisions operate independently and where they make use of significant amount of capital. Okay, so your first is objective of performance measurement system. This is one of the main objective of how to develop performance measure system for divisions, especially your investment centers. where we try to ensure that every division contributes positively to the overall goal of the organization. Okay, so a good performance measurement system is something where you should achieve four important purposes. First is provide information for economic decision. Next, this particular system will help the management to decide where to invest more capital, which divisions are performing well, and also whether a division should be expanded or reduced or restructured or closed. So it supports your long-term economic decision. It will also help you to facilitate control of division operation, where you will be monitoring cost, profit, and investment. And also, it will help you to identify inefficiencies and also take corrective measures or actions when performance is unsatisfactory. Okay. And managers also get motivated to improve their performance when it is measured fairly. So, when it is measured fairly, ultimately it creates your goal congruence between managers and the organization. And also, it will help to, for evaluation to divisional managers, which acts as a basis for their appraisal. That means to judge how well managers have used their resources for their promotions, incentives, and rewards. Because performance measurement is something a tool for your managerial evaluation. Next, coming towards your investment center. Okay. Investment center is a decentralized division or a subunit where the manager has the maximum authority and responsibility, and they have got a proper control over your production methods, your investment decision, your pricing decision. So this makes the investment centers more advanced than cost or profit center. Then we have also seen about your investment center and profit center, and also the importance of relating profit to investment. Then we have seen about your capital expenditure control, where most organization they have got a strict procedure for approving capital investments, as well as detailed evaluations are being calculated or evaluated before investing in new projects. So, however, all those investment center they try to have performance measurement that goes one step further. So it helps us to evaluate the combined effect of all past as well as your present investment decisions. So this is not just individual projects in isolation, but this will give you a holistic view of how well the capital has been utilized over time. Okay, then so this is all about your what do you say your 10th unit. So investment center performance evaluates how effectively a division uses its invested capital to generate your profits while motivating managers to act in the best interest of the organization. Now, next coming towards your 11th unit. Your 11th unit is about management audit. In this unit, we are going to understand the concept of management audit and its process, and also to know the techniques of management audit, discuss the role and scheduling of audit, and also it will explain the management audit report. So, how it is being structured, first you have introduction, then you have the concept of management audit, its ma- process, then you have techniques of management audit, you have role of audit, scheduling of audit, audit plan, then you have management audit report, and followed by your summary. Coming towards the first, that is management audit. Okay. Now, in today's business organization, they are basically subjected to multiple types of audits. Like how you will be having internal audit, you'll be having financial audit, you'll be having cost audit, okay, management audit, or energy audit. What is the meaning of this audit? From where this particular concept of audit came from? Audit is something, this is a Latin word, audire, which means to hear. So traditionally, audit is meant listening to explanations and evaluating their usefulness. So in modern organization, audit means a kind of a systematic examination of specific area such as your financial activities, your organizational activities, your management activities, and your social responsibilities. So here each and every activity, they have got a defined objective. They have got a delegated responsibility. So the main function of this audit is to check whether all the responsibilities are properly discharged and the objectives are achieved or not. Okay. Next, coming towards your management audit. What do you mean by a management audit? Management audit is a comprehensive examination of management performance in an organization. So here it includes your evaluation of managerial effectiveness. Here we are going to calculate the quality of your managerial decisions. Some recommendations for your improvement are being taken into consideration. How it is well reliable to your management information, and what are the compliances with your company's policies and your professional standards. Okay, so in lieu to this, we are going to just have a what do you say, a difference between your administration and versus your management. So, administration basically it deals with your organizational structure, it deals with your systems and procedures. What does management deals with? Basically, management deals with your leadership, it deals with direction of people, and also it deals with control and coordination within the structure. So here the management audit it focuses mainly on management, not your administration alone. And why this the concept of audit is necessary? Because here the management audit focuses mainly on management. Okay, and in many modern companies, whatever the ownership is there, it is widely spread among shareholders, and control is in the hands of a few managers only. So this separation of ownership and control, this will create a need for independent examination of how you are going to measure the performance. Okay, so here the management audit will try to examine your organizational objectives. Okay, it will help you to go up with the policies, the procedures in terms of the objectives, and also it will help you to go for adequate performance of an organization in terms of objectives, policies, and procedures. That means it helps you to go up with the performance in achieving objectives. So it avoids duplication with other audits. Like if internal audit, they are checking the procedure, the management audit checks effectiveness of procedure. Are you able to figure out? If internal audit is checking the procedure, the management audit will check the effectiveness of procedure. Okay, so here the management audit is non-routine, but ultimately it is trying to increase a regular feature of it. And it is not limited to only financial matters. It also helps you to evaluate your efficiency. It also go up with your effectiveness. It also go up with the quality of your management decisions. Okay, so here we have different definitions that are given by different authors. Okay, the first definition that is given by William P. Leonardus. What does it says? Management audit may be defined as a comprehensive and construction examination of an organization structure of a company and its plans and objective, where it serves as a means of operation and its use of human and physical facilities. That means here management audit it examines your structure, objectives, your plans, as well as use of your human and physical resources. Okay, as said by Leslie Howard, Management audit may be more specifically defined as being an investigation of a business from highest level in order to ascertain whether sound management prevails throughout, which facilitate the most effective relationship with outside world and the most efficient organization and smooth running internally. So here it examines the organization from top to bottom to ensure sound management throughout. Okay, so in lieu to this, we have different definitions which are given by different authors. Okay, so from all those definitions, we can come to a conclusion that management audit is systematic in nature. It has its own objective. It is comprehensive and it is concerned with overall managerial performance. And also, it tries to evaluate your organizational structure. It tries to go up with the plans and policies. Okay. It will also help us to go for systems and control, human and physical resources, information system. Okay. And the concept of this is given, introduced by T.G. Rose. Okay. Where they have evaluated nearly 52 public companies. So here you can see. Okay. And also it gained importance only after 1973 oil crisis. And also the focus is shifted towards managerial performance evaluation. Okay, so coming towards the coverage of it, as you can see here, unlike statutory audits, yes, this management audit, it has no fixed boundaries. Okay, it covers all functional areas such as your organization, your personal, your marketing, your finance, your manufacturing, your R&D, and also it focuses on managerial effectiveness, not on vouchers or your documents. Okay, and also it evaluates all management functions starting from your planning till innovating, that is planning, organizing, staffing, coordinating, communicating, directing, motivating, controlling, and innovating. Next, coming towards objectives of management audit. What are the primary objectives of management audit? The first is to appraise performance at all levels. Second is to identify decisions which are not aligned with objectives. Okay. Third is to ensure objectives are understood clearly. Fourth is ascertain the controls provided. Fourth is to ascertain the control provided at different levels which are adequate and effective in accomplishing management objectives or plan of operations. That means to evaluate effectiveness of controls. Fifth is to review organizational structure. And the last is to evaluate management plans. Apart from this, what are the additional objectives? Additional objectives are to ensure optimum utilization on all the resource that is being employed. Okay, and that includes your money, material, machines, means, and methods. Okay, that means here optimum utilization of resources takes place. Second is to improve policies and procedures. Third is to strengthen internal controls. Fourth, to detect weakness early. And the last is to prevent organizational sickness. Okay. Now, what are the functions of management audit? Here, the management audit will try to examine effectiveness in marketing and distribution, in manufacturing services, in human resource management, in personal and industrial relation, in finance and accounting, and in research and development. Okay, so the responsibility of management is to achieve objectives effectively that verifies the achievement of your management audit. Now, what are the different types of management audit? First, we have financial audit, then we have cost audit, internal audit, operational audit, and management audit. Coming towards the first, that is financial audit. Financial audit is statutory in nature. It will check the correctness of your financial statements. That means it is what you can say post-mortem in nature. And this particular audit is not useful for managerial decisions. Cost audit. Yes, we were discussing about cost audit. Cost audit is legal reporting to government. Here it focuses on efficiency of product cost. And also its scope is very limited, okay? And it can be extended into your management audit. Third audit is your internal audit, where it is being conducted by internal staff, where it ensures procedural compliance, okay, with limited interdependence. And it does not evaluate top management. Next, you have operational audit. Operational audit concentrates on seeking out aspects of operation in which waste, inefficiency, and excessive cost would be subject to reduction by the introduction of improvement of operating control. That means operational audit, it focuses on your operational efficiency. It is being evaluated at supervisory level and it is also called your micro level management audit. Next is your management audit. Management audit extends the entire management decision making areas, and this has a broader time frame to analyze past, present, and future. Therefore, it becomes a qualitative audit and not audit of only value and quantity. So, management audit is comprehensive in nature, where it covers your past, your present, and future. And also, it focuses on policy, strategy, and decision making. And this is qualitative in nature. So, very quick, we are going to see about the benefits of management audit. Uh, Management audit will try to improve your managerial effectiveness. It will help in framing objectives and policies. It will help you to strengthen planning as well as in management information system. It will also help you to identify weakness and sickness. And also, it helps in your rehabilitation of sick units where you can improve your resource utilization. And also, it helps you to assist in government and public sector evaluation. Apart from this, it will be useful in mergers, uh, takeovers, and restructuring. Next, you have strategic advantage of management audit. First point, manager audit helps in decision making areas such as make or buy, closing down of a unit, acquisition of a business. That means it supports major decisions such as make or buy, expansion or closure of units. Second, it also helps in assessing the efficiency of executives, where it serves as a moral check on the executive. That means it acts as a moral check on executives. Third, it improves utilization of resources. It provides your expert opinions and also it encourages your professional management. Okay. And what are the shortcomings of management audit? So first is it is expensive, that is not suitable for small firms. It is not well defined, that means no standard procedures are being regularized. And there is no practical limitation, that means recommendations can be theoretical in nature. Okay, so with this, I'll just wind up my today's class. In our next class, we'll continue with your management audit process. Okay, so thank you all for attending my session. In our next class, we'll continue with your management audit process. Thank you once again.